All right, let me make a short introduction of each of our speakers, and then I'll ask each of you just to talk a little bit about your platform and how it's different and how it's placed in the ecosystem. All the way on the end here, you'll see Gene Barash. He's the Vice President of Business Development at Realty Mogul. It's one of the early and largest platforms out there. His primary responsibilities include pursuing opportunities for growth and strategic partnerships with companies with US and abroad. His prior responsibilities at Mogul included running corporate ops and asset management. Next to Gene is David Manchuri. David's the president and co-founder of Asset Avenue. David's a passionate entrepreneur with more than 10 years of proven success in startups and commercial real estate investing. Prior to Asset Avenue, David founded two other companies, and they actually had combined revenue of over $30 million. Next to David, you've got John Robertson. He joined CrowdStreet in February 2015, and he manages investor relations for the company. He works with all of the high net worth and accredited investors in a variety of different ways, so he's got that interesting perspective for you today. And finally, we've got Ryan Granito. He's a vice president of real estate for Fundrise, and he's actually based here in LA and San Diego. Ryan's focused on developing relationships with local developers and property owners to extend the company's presence on the West Coast. Now, good afternoon, guys. If you wouldn't mind, just one by one, just maybe talk a little bit about your platform, what the specialization is, where you started, how long you've been around, really a little bit about it. Ryan, you want to kick us off?
Sure. Vice President, my name is Ryan Granito, Vice President of Real Estate at Fundrise. We are an online capital provider through syndication efforts online and crowdfunding. We're based in DC and expanding throughout the country. Can you guys hear me? Okay. And what we do is we invest in every deal and transaction that we choose to invest in, and then turn around and syndicate out the economics on the back end. So we take the syndication risk off the table for the sponsors or the developers, and we'll invest in any type of asset class in the real estate spectrum, aside from one-off single-family homes, really commercial assets. Based in DC, like I said, I'm out here in LA, cover Southern California and other parts of the West Coast.
Good afternoon, John Robertson, Investor Relations Manager with CrowdStreet. Thanks for having us. At its core, CrowdStreet's a software and services company. So we provide a public marketplace for accredited investors to review and invest directly with sponsors in those deals. The second aspect of our business is what we call Sponsor Direct, and it's essentially white labeling that entire technology stack and deploying it on a sponsor's website. So if a sponsor wants to go out and raise capital through its own friends and family and model that it's run for the past few decades, they can go on there and set up a portal on their own website, branded and looks identical to their own website, and they can raise capital that way. They can also go onto our marketplace and get introductions to individual investors, high net worths, and manage them through a platform, a software technology that's built both on the front end and back end.
My name is David Manchuri. I'm the president and co-founder of Asset Avenue. We are an online lending platform. We're a direct lender. We only finance real estate developers and investors who are looking to finance a residential non-owner occupied property. So 1 to 4 units, up to $2 million per asset. And we raise our capital from institutional sources, private equity funds, hedge funds, family offices, and wealth managers. We don't really, we haven't employed the crowd model. And so that's not really where we source our capital from to lend to our borrowers. We focus on the residential non-owner occupied market because we think it's a strong market to target that banks can't really tap into. And the yields are typically higher from a lending perspective than their counterparts on commercial assets, commercial bridge loans. And we don't do any equity financing. It's purely just a business strategy that we focused on from day one to always be a first trustee lender.
My name is Gene Barash, and I work for Realty Mogul. We're an online platform for real estate investing, connecting accredited investors and institutions to sponsors and borrowers that are looking for funding for their real estate transactions. One of the things that differentiates us is we offer the full capital stack to any sponsor or borrower looking for capital. So you come to one source, you can get all your debt, all your equity, from a combination of institutional partners and accredited investors.
Sounds good. Thanks, guys. You know, from talking to a lot of people in the audience today, I realize a lot of folks are new to crowdfunding. If we could just take a moment And maybe, David, you start out, just explain nuts and bolts. What does it mean to actually do a deal with you? How is it structured? What's the legal look like? Are the first liens? How's this all work?
Sure. So for us, we act as a direct lender, and we hold the note as the lender, and we service them on behalf of our institutional investors, where we raise the capital from. So what we do is we drive borrowers to our website. We have an online application. It's about 12 questions. They fill out some basic initial information on the property location, the borrower's experience as an investor, the borrower's credit score, and what kind of financing and leverage they're looking for in the deal. And we specifically ask for those questions because our pricing engine is driven by all of those factors. And when they submit a deal online, we have a data science team that's come up with our own credit model where we've analyzed over 12,700 zip codes and over 500 MSAs across the country. And we know exactly which markets we want to lend in based on the health of the market itself. And they'll either automatically get disqualified or they'll automatically get pre-qualified based on the information they've provided. We have minimum FICO and liquidity requirements, so a lot of times people will get kicked out. And if they get pre-qualified, they see a suite of loan options. They can choose whichever one that they like. They pay an application fee, and that signals to us that they want us to move forward. We could close a deal in 10 days for our borrowers. It's a truly asset-based loan. And that's it. And then we provide monthly, quarterly, and annual reporting to our investors who are providing the capital, who basically want to lend on our credit and lending strategy.
Good. Gene, Mogul has built a great reputation in the commercial space, raising money for equity. The same sort of question. I'm a developer coming in, I'd like to buy maybe a multifamily building. How does that work? What's the structure look like? What's it look like for me?
One of the very first things you'll do as you're a developer is you'll log on our platform and you'll see what our guidelines are. You'll submit an online application talking about your background, your track record, your business plan for the property, and that will get run through our system very similar to David's, where we've automated a lot of the initial underwriting, where if you don't fit the criteria for experience, where you've done at least $25 million worth of real estate, if you don't fit the necessary criteria for the type of real estate that it is, where we won't do ground-up development. We need existing properties with existing cash flow, with occupancy at least over 70%, and various other factors that's going to vary deal by deal and market by market. You plug in that information, then you receive a call from one of our originators that will talk to you about the deal and structure it from there. The typical structure, if that's the question, is really we come in for those type of deals as a limited partner. We aggregate our individual investors into a single LLC and then invest as one LLC into your entity that typically holds title to the property. So you do the day-to-day management. You're the expert in that particular piece of real estate in that particular area, and we want to be passive investors. We want to be good partners and let you manage it. We want to provide the financing for it. Your obligation to us is to execute on your business plan, provide financials, and do the necessary reporting so that we can keep our investors apprised of what's going on and hopefully have a good real estate partnership.
Good. John, maybe you could dive in a little bit with CrowdStreet. What are some of the new problems you're solving from a sponsor's perspective, people in this room, that your product technology helps them out with?
Sure. So really, it's the back end, right? Many sponsors have had great success with acquiring and building relationships with individual LPs or accredited investors, and so their problem isn't raising capital anymore. It's really the back office and automating the communication and the reporting and all the logistics and brain damage that really requires a number of people kind of in the back office and from an investor relations standpoint to continue to communicate with these investors. And so our software platform has a number of technological features such as uploading distributions and information to their LPs and uploading, for example, K1 season's coming up, right? How do you send out your K1s to all your investors? Is it by mail? Well, you can do it now in a safe, secure, cloud-based system on CrowdStreet and upload those and communicate to your investors that way. So we take great pride in listening to our sponsors and having them guide us and really form the product around the brain damage and pain that they feel on the back end for managing hundreds of investors, right? Because the big problem here in crowdfunding is, right, well, we have 50 private investors. Well, what happens when we have 150? Do I need to do all this reporting with them, and managing that day-to-day communication with them can be cumbersome. And so when you provide great tech behind it, it certainly helps make that process more streamlined and better.
Ryan, one of the big things the whole industry's been talking about for some time now is the E-REIT, Fundrise E-REIT. I said 2 words about it earlier, but if you wouldn't mind, can you dive in, explain what it is, explain how it works, why it came about, and really what's going on with it today?
The E-REIT is a little bit different than our typical financing structure in a sense that we're syndicating up front from accredited and unaccredited investors using Regulation A+. We chose to apply it in a REIT vehicle, and it allows for a broader public, or the general public for that matter, to invest in our deals through a blind pool that we raise up front and then invest into real estate assets on the back end. Our traditional structure historically has been that we would invest in the deal and then turn around, syndicate it out afterwards. So this is a little bit different in that sense, but allows for a broader investor pool, and inherently will be a little bit more diverse than investing in one deal on your own. There's going to be quite a few assets in the REIT structure, and the amounts that we're aggregating are $1,000 and more. So it's a lower investment upfront to buy into the vehicle.
Now, you guys pioneered this. Is this a structure that the other platforms, either here on stage or in the audience, can use down the line as well?
Definitely, we use Regulation A+ to raise this vehicle, and certainly it's not without more restrictive oversight, and it's a little bit more cumbersome. There's rather than using certain regulations that allow you to do private placement, this is an SEC registered document, a vehicle, and there's oversight, management, and there's also, it's a cumbersome process. So it takes some time to get it structured and raised. And then the other side of it is you need a track record in order to do that, because what the risk is that you launch this REIT and no one signs up. And so there's a couple different parts of it, but we've found success thus far, and we're going to continue to utilize this to grow.
Is it starting to invest already? How many has it made investments so far? Do you know?
I don't know off the top of my head. I think it's made about 10. I would say.
Just to
Is
pause
it
real.
public? I was just curious if it's publicly listed on an exchange. Okay, got it.
We'll keep diving in here, but I wanted to let the audience know, if you have questions, let's make this a discussion. We'll keep going. Kareem?
Kareem Jowdi, your partner in real estate. I have a question for the panel. There are three syndicators plus myself here. We are small syndicators. We raise anywhere between 500,000 to 5 million equity. Normally, in my case, I put 35% down payment on apartment building, 40% down payment on commercial. And as managing member, or as a general partner, if you like, I always put at least 10% of the money raised in my pocket, so I have gain. The question I have been asked, and I'm asking you too, should we try to make our own platform, or can we work with one of you? Because we look for 2 things, equity and also loan. Loan, when we buy property, we want to turn it around. As you heard this morning, I buy property, and David knows that, and turn around. I always make at least, I would say, 3 years to 5 years, holding period, maximum 7 years, but some of them is maybe 1 year or 2. So a value added. So should we work with one of you guys, or should we start our own?
I'll jump in. I think we could certainly work together. So I would say split it, right? So, and we would be in a preferred position similar to mezzanine debt, with no participation, fixed duration, fixed term, and what it does for you is you get to keep all the profit above the interest rate that we're charging for that particular instance. And I see that as it's a good portion. It leverages your equity, and you get to keep majority of the project proceeds.
I'm John. That's okay. So CrowdStreet can be a complement capital raise. We're not going to tell you that we can raise all 5 million of your raise through our marketplace. While we've had many successful offerings that have raised north of 3 million, our sweet spot's kind of that 1 to 3 range. So if you want to go out in the marketplace and raise, 2 million through your own friends and family network, and then also an additional 2 or 3 through CrowdStreet, we'd be a great platform to do that. But you also would have to take on the responsibility of managing individual investors. And so that's the difference, right? CrowdStreet's going to introduce you to high net worth individuals from around the country who can partner with you not only on this deal, but future deals going forward. And at the end of the day, you make the terms, right? We can guide you to what our investor community has liked, what certain deals have been very successful in terms of the waterfall structure and the splits and just where they fall in the capital stack. But at the end of the day, you make the terms, and the investor gets to decide if that's a deal for him or her or not.
So Kareem, we could work with you on any residential non-owner occupied property, investment property, that's up to 4 units. And in California, we go up to 75% LTV and we'll provide up to 100% of your renovation amount with a cap of $2 million on the loan amount. Depending on what state it's in, outside of California, whether it's a judicial or non-judicial state, sometimes we cap out at 70% LTV with 100% of the renovation amount.
So for the larger commercial real estate properties, we can offer financing on the debt side anywhere from $5 million to $50 million. I think Ray mentioned actually one of the deals where we actually were able to successfully implement our full capital structure, where we were able to partner with an institutional partner to provide the debt, which was about $49 million, and then we raised another $3.5 million from the crowd. So we would definitely look to structure something like that, where an institutional partner provides all the debt. Our accredited investors provide up to 90% of the equity. You provide the other 10%, and they come in as a JV partner, and you go to one single source for all your capital for that project.
Yeah, absolutely. Anyone else? Or? Yes, please.
Yeah, question to Ryan, Gene, and John. Can you tell 3 questions for each of you? First, how much does it cost a sponsor to use it? If I'm going to go to each of you to raise the money for my deal, how much are we looking at in terms of cost? At what point do they become non-refundable costs? And how long does it take typically to get to know if you're going to actually be able to raise the money? And what's the sweet spot in terms of the optimal raise amount for each of you in terms of what can you give a high confidence level that you can get this amount raised?
Well, as far as what our sweet spot is, right now it really depends on the property, but I'd say 2 to 3 million is typically what we've been raising on the majority of our equity deals recently. The timing, you're typically looking between 30 and 45 days is ideal. That's to get through all of the underwriting, all of the fundraising, all of the legal documents. And as far as fees go, we're affiliated with a broker-dealer, so your fees are due when the equity is committed to that deal, and it's typically about 3 to 4%.
3 to 4%. And so you're saying that the sponsor's not going to know for 30 to 45 days whether or not you're going to be able to actually get the money for them?
So 30 to 45 days to complete the transaction. When we underwrite the transaction, you'll know within the first week or so whether it's something that we could actually put up. It really depends on how quickly you're able to provide the diligence documents to when we could tell you we can raise for the deal or not. And really with us, it's best efforts, right? So when we put the deal up on the platform, you should absolutely have a plan B in mind if you don't feel that you're confident that we could raise it. But if you look at our track record where we've syndicated out nearly $200 million worth of real estate across 300 properties in the last 2.5 years, and you have a similar property, that is enough for most sponsors to trust that we will actually be able to raise it.
So at what point do we have to actually give you money that becomes non-refundable for us to know whether or not what we can do?
The only money that you owe us is when we actually provide the equity and we close the deal. So at the time of closing. So when you purchase the property and the equity is committed, it'd be at that point.
Sure, I'll take a stab. So it's a $10,000 posting fee to put your property up on CrowdStreet's marketplace. That's non-refundable, and that's obviously a pushback we potentially can receive from sponsors who, right, they want to see results before they start writing checks. That being said, kind of to your point, right, we've collected data over the last 2 years of posting offerings on our marketplace that would give us great confidence to suggest that given the quality of the sponsor, the location of the asset, and the terms and structure, that these are the types of deals that our investor community are keen to invest in. So while we can't provide you 100% certainty or a guarantee that 100% of your $3 million equity raise is going to be fulfilled, we suggest having a backstop in place, or potential other partners who can either increase their loan amount or increase the partnership with your JV partner, or whatever the case may be, because this is a direct to investor model. So we're not underwriting the deal to CrowdStreet's parameters. We're making sure that it's a potential fit for our investor community, and that we've done the background checks of the quality of the sponsor, and that again, that it's a fit for the investor community. So again, how long does it take to raise the money? Successful raises are typically, it's difficult to raise all the money under 30 days. So we like to see a window of 30 to 60 days on the marketplace. The underwriting process is not something that I'm all that involved in, but somewhere around the 30 days, something like that, right by the time we gather all the materials and vet the sponsors to the degree that we do. And an optimal raise for us is, like I said earlier, anywhere between 500,000 and $3.5 million.
Ryan?
So I'll take them out of order. So I'll start with our process. The process for us is we're pretty hands-on. We kick the tires. You have a deal, you send it to myself or another originator in DC, and we'll start asking some questions after review. In a week or two, we'll take it to an investment committee. At that point, we'll issue a term sheet if we want to move forward. So that's 2 weeks to a term sheet. Once the term sheet is issued, we collect the term sheet along with a deposit that varies based on the size of the deal. $5,000 non-refundable deposit, and once we enter into an agreement to commit to funding. Once we issue a term sheet, we're a little bit different, as we're not a best efforts lender, we are an investor. And so we will provide the money upon closing, barring any unseen items during due diligence that typically does not take place. And ideally we have 30 days, but because it is 100% discretionary, we can close as quickly as we can process the information. And it really depends on whether or not we're in a senior position or a subordinate position as well. If you're working with a bank and they have a lot of underwriting documents or reports already ordered, we can review those reports. We can close as quickly as in a week or two. Our sweet spot as far as funding amounts are anywhere from 2 to 20 million today. I mean, in a couple of months, it could be 2 to 100 million. We're growing pretty quickly.
All right. Anybody else? We'll just.
Can I get David to answer the same question?
Yeah, so we're a direct lender. When borrowers go to our website, it takes 2 minutes to answer the questions and find out if they pre-qualify. And once they get pre-qualified and they pay their application fee, $250. It takes 10 days to close, sometimes less. The fastest we've done is 3 days, but that was with a borrower who was in escrow for 45 days with Wells Fargo, had an appraisal, and Wells backed out last minute. So we had a lot of the diligence already done for us, and we were comfortable using the appraisal that was 2 weeks old. But it typically takes 10 days to close. We charge borrowers 2.5 points if they apply directly to us. If they're represented by a mortgage broker, because a lot of our business comes from brokers representing their clients, we drop it down to 1.5 points, and we allow the broker to add their fees on top of our 1.5 points, up to whatever they decide that they feel comfortable putting in front of their client.
You had a question?
I actually had a couple of questions. How does the Fundrise e-read, which I know is getting a lot of press, and you guys are really pushing it, and it opens and closes and opens and closes, it seems on a weekly basis. How does the Fundrise e-read differ from a publicly traded e-read? Well, read.
Publicly traded REITs are obviously, they offer more liquidity than we're offering. We're offering liquidity on a quarterly basis, but we're less susceptible to market changes that are affecting the stock market or exchanges. We are just strictly based on economics of the deals that we invest in, and that's a little bit different. It's more like a private REIT, non-traded REIT, except our loads are much lower. Our fees range from, in that structure, anywhere from 1% to 3%.
And the second part of the question is, in terms of underwriting, which is key to any successful deal as far as how diligent the underwriting is, what do you guys do as far as auditing the financials of the sponsor? You know, or lack of a better comparison, Madoff makes up returns and financials. How do you know that the financials that are being submitted to you by the sponsor are really true financials to make a final determination?
Well, we are an asset-based lender for the most part. We will obviously underwrite the sponsor as well. We check for certain liquidity requirements. We don't have necessarily thresholds. It's malleable somewhat. We don't have a box that we operate in. But we interview the sponsor. We see what their personal financial statements look like, and to see whether or not they have enough liquidity or net worth to make capital calls when those arise. And so we don't want to be stuck in a situation where there's X amount of equity required to do the deal, another X amount of equity that's required to take care of change orders throughout the transaction, and the sponsor's unwilling or unable to provide that equity. So I don't know if that particularly answers your question, but we look at it a couple different ways, one from the sponsorship point of view, and the way I look at it is, what has the sponsor done in the past? How have they done it? Have they executed their plan? Is their plan something that looks achievable or realistic? And so we look to see whether or not first of all, if the plan makes sense, second of all, if the sponsor can execute it, and third of all, if we can make an arrangement or agreement to work together.
Maybe the same question for Gene. Mogul. How does Mogul handle verification of docs, and especially once something's in process? How do you know that 8% was actually the return last quarter?
Sure. So a lot of this is really predicated on really good underwriting. And we've been fortunate to hire a lot of people with really impressive real estate chops. Our head of credit used to run a real estate group for JP Morgan. Our chief production officer out of New York, she was formerly with Credit Suisse and ran the small balance commercial lending department over in Guggenheim. So they brought a lot of traditional real estate chops to the underwriting, and we've laid our technology on top of that to really help us understand the real estate and understand the sponsors and understand the deals. And what I mean by that is we look really closely into 4 different things. We look at the property itself, the financials on the property. We look at the market. We look at the demographics. We look at the employment rates. We look at the transportation. We look at the third-party fundamentals, or the third-party reports, rather, which are the inspection reports, the environmental survey studies, the financial reporting that the sponsors have provided in the past. And then when the deal's in process, some of our sponsors actually are partnered with large institutions, and they provide audited financials. So when that's the case, it's really easy. There is a group that actually audits the financials that will provide to us. But a lot of our sponsors do not. These are private placement offerings. We rely a lot on the sponsor's track record, their experience. We get personal references, business references. Obviously, in the case of Madoff, that doesn't really help out too much. But a lot of this is partnering with the right groups, and we spend a lot of time vetting the sponsors, really digging into their background, their track record, making sure they've done enough real estate, and making sure the teams that they have in place are able to execute.
You had a question over here?
Yes. We buy self-storage properties, and I was wondering, to save time, do you offer any type of pre-vetting process where, based on the asset class, being self-storage, my credentials, my past history, before I enter into an escrow, is it possible that I could get your attention to see if you would be even interested in that asset class and even our operation? That way we could all save a lot of time after we, went into an escrow.
So do any of you underwrite sponsors before looking at individual properties first?
We don't, but I can tell you that I like self-storage, and so happy to take a look at the deal.
Absolutely. I mean, underwriting the sponsor is really paramount for our business. At the end of the day, we need to make sure that our interests align and that your goal is to go out and meet and manage individual investors and partner with them long term, and then communicate with them on an ongoing basis. And if we can run a marketing and digital technology advertising modality for you, and then a technology system to manage them on the back end, then yes, we're more than happy to work with the sponsor and understand your background and track record before even looking at the deal, and that's really paramount.
On our platform, borrowers can go on the site and get pre-qualified in 2 minutes, whether they're in escrow or not. So a lot of borrowers end up going to the site and try to get an idea of pricing so that they know how much they should be bidding on the asset before they go into escrow.
So we love self-storage. We've done a handful of self-storage deals, and we always underwrite the sponsor first before we'll look at the deal level.
Yes.
Sure. So two complicated questions, so I'll try to be brief. We work with institutions on various levels, and they vary. They can be small funds. They could be life insurance companies. They can be large commercial banks. And every one of them is looking for a different type of product, so there's really no one-size-fits-all. We have institutional partners that like to invest in senior debt, typically longer-term, lower risk, lower yielding product. And we have institutions that are very opportunistic, and venture funds that want higher risk paper or higher risk deals and want to invest alongside accredited investors. So it really varies. And as far as foreign markets, that's again a loaded question. It's really interesting. It's I had the conversation I think with David earlier in terms of it's that shiny object that everyone wants to get after, and no one's really quite cracked it really well in terms of and opened that pipeline to foreign capital. But we're actively pursuing partnerships with groups, particularly out in Asia. I had the ability to travel down to China and work alongside some of the P2P and crowdfunding companies out there. And if we're talking about crowdfunding here and the success that it's had, if anybody's read the news and kept up with China, I mean, they are blowing us out of the water. There's so much interest there in internet finance and so much investment to be had that once a group actually figures out how to get it done, I think that will be the next flow of capital into this industry.
David, do you want to touch on institutional investors as well? You've chosen to focus that route.
Yeah. So it's slightly different than what Gene said. We actually have pre-negotiated contracts with our institutional investors. So there are a lot of institutional investors that want to put capital out into debt deals or equity deals. They really view us as origination partners. They don't get the benefit of standing on stage as a crowdfunding platform and seeing a lot of deals from great sponsors. So they basically piggyback on our marketing abilities to see deals and fund those deals. With us, we focus on working with private equity funds and hedge funds who actually want to make a commitment to us to deploy their capital on predefined lending guidelines. So I can speak very clearly to what our lending guidelines are because we have capital ready to deploy into those products. So it's a little bit different, and it gives us a lot of confidence that we know exactly how much money we could put out, and we never have to worry about the capital to fund a deal.
Sounds good. Other questions?
This question for Gene. Can you do one big debt issue on multiple properties that you already own?
That you already own, so cross-collateralized debt, is that what you're asking for? Yeah, you can definitely issue debt across multiple properties.
Any other questions? All right, I guess we're wrapping up, getting close to lunchtime here. Won't hold you back. If we could give our panel a hand here.